All right, Prateek Agrawal joins us, represents MOSL, Head of Business Investment Strategy with Motilal Asset Management. Prateek, good morning. Thank you for joining us. It's been quite a yo-yo kind of in market. You think the excesses in the market are over? It's time now to start buying the fear and the volatility?
No, so that has been our thought for some time now. Typically, we have seen that a 5 to a 6% kind of a correction is a good correction, and buying comes in. This time around, we saw intense selling in the month of October. November saw a reduction. Now, if this month sees further reduction, chances are good that the bottom formation that we are talking about happens. There is some data to cheer about. The GST collection data was good, and while the GDP data for quarter two was lower than expected, very clearly there were two spaces which pulled it down: mining and electricity, and the lower growth there was clearly on account of better monsoons. I think as we get into quarter three, chances are we get to see better numbers. There is definitely hope in the air.
Sectors will drive this better number perhaps. Do you think consumption would be the one to bounce back, or do you think it will be the rest of the pack which will start showing signs like IT, etc. first up?
No, so consumption, one has to clarify what kind of consumption. I think if we are looking at staples, I don't think that's the story, but many pockets of durables are definitely showing very strong growth. So one should be focused there. Yes, IT is seeing some traction. Whatever is proposed by the incoming president in the US would mean more savings on account of lower tax in the US corporates, and hence probably more IT spending. So that helps, and actually it helps banks as well, because if yields are higher for longer, the NIM pressure that people worried about would not be there. So it's good for India, good for the market. Yes, bond yields being high makes FPI pull money out of the country. But that said, once that settles, it's actually not bad for us.
It's been the year of IPOs, one can say. Lots of big bang names and even smaller ones that have hit the street. What's your sense, Prateek, when it comes to the recent listings that we've seen? Has there been anything in particular that has caught your eye, and how are you looking at the momentum here?
No, so we are active in IPOs. The two, three of our managers are very active in IPOs, but what we are trying to do is to focus attention on category winners, the largest one or two companies in a space, new emergent fast-growing spaces. So there, the chances of going wrong to our mind is lower, because otherwise, when you are getting so many IPOs, even now it is difficult to remember every name which is IPOing. Just imagine what happens after 3 months or 6 months. People will struggle to remember those names, and the stock prices, many of them could be languishing. But in newer emergent themes which have a good growth tailwind, if it is number one, number two player in the industry, we are definitely interested.
You were underweight banks couple of months ago. Have you changed your outlook there?
I missed the first part of the question.
You were underweight banks, right? A couple of banks,
Yeah.
financials. Can you hear me now?
Yes.
Yes. Have you changed your view?
No. So while we are saying that financials will benefit from the environment, so bond yield sustaining at higher levels for longer benefits banks. Yet, if you see our portfolios, we continue to stay put in our positioning, which is broadly X of banks. Many of our portfolios continue to be zero banks. The whole thought is that while it is incrementally positive for banks, the spaces that we are focused on have a growth tailwind, which is an order higher. and hence we believe our positioning should continue to deliver alpha to our investors.
Okay, so of course, watching out for financials at that. But what do you make of some of the other sectors? Because I see across the board that you do have a bit of a overweight of sorts when it comes to IT companies, whether it's an L&T Tech, whether it's a Coforge, whether it's a Persistent Systems. It does feature on a lot of your, kind of holdings, the mid-cap IT at that. Are you increasing your exposure there further? What's the latest on IT? Incremental positive or trimming positions?
No, so we are not there in large cap IT. All the names that you took were mid and small cap IT. So we are there because there the growth quotient is an order higher than the index earnings growth quotient. And two, we are there in new tech. So all of our funds, there would be some sprinkling of newer tech names. So we continue to be positive on that space. Depending on valuations, we may trim a bit or build the space.
There's an idea of 2-3 trends where you think that, okay, there could be 15-20% volatility, you don't know because of market conditions, technicals, liquidity, but you are reasonably confident of the interplay between value and valuations and growth, which is that these are companies or businesses which you see that for next 3 or 4 years can compound at 15-18% earnings.
See, Nikunj, yes, we are positive these spaces for medium to long term. But at the same time, at least I tend to see a long term as built of several shorter terms. And we make one space compete with another space. If we see another space, another stock delivering a much better combo of growth and valuations, we may change.
My point is, which are some of the other themes where you think there could be a 15 to 18% earnings growth and valuations are reasonable? Stocks may go up and down, that's a function of market condition, etc., etc. But as a fund manager, you can only talk about earnings, right? Where you see 3-4 years of superior earnings growth.
No, so renewables is one space where we are reasonably positive. Defense is another. Electronic manufacturing, new tech, luxury consumption. Take whichever cut, be it premium malls, be it jewelry, be it expensive housing. Capital market is a space that we are reasonably positive about. Take exchanges, take AMCs, take a few digital brokers. So broadly, these are, and of course, cap boards. So all lines of capex, we are reasonably positive. So cable companies would be there everywhere. Electrical motors, robotics companies would be there in our fund house. So these are the broad spaces where we think earnings growth will sustain at higher level for a longer period of time, and we are positioned here.
Started the word with green and clean, right? I mean, am I right? That means you are bullish on renewables.
Yes, we are bullish on renewables.
Now, renewable is a very long tail, right? I mean, I can talk about a power transmission. I can talk about a solar company. I can talk about a wind company. What do you like within renewables specifically?
Yeah, so at the current juncture, we like many spaces. So if there is a cable company which has product suited for renewables, we like it. We like the wind and solar equipment guys at this juncture. So pretty broad spectrum liking. If there is a transformer guy, we have that as well in the house.
And I also wanted to get a sense from you regarding autos, because at least your research team had downgraded autos just a few weeks ago. What are you doing around it? Are you completely exiting the auto, the two-wheeler, four-wheeler category, commercial vehicles? And what about the OEMs there, the manufacturing ones at the smaller parts, etc.?
No, so it is not our research that you got to know. It is institutional equities, which is a group company, and they are entitled for their views. we are entitled to ours. In our house, we have stayed clear of autos for a very long time. The current autos derive a lot of their valuation from ICE, internal combustion engine, which we believe is a limited period thing to look at. We really believe in transition to electric vehicles. And this transition, we believe, will not be net value accretive for the auto industry. So broadly speaking, our funds are away from ICE. Yes, in some fund, there may be a small exposure, but more on the EV side. You see them as winners in the EV and hence maybe make some money, but otherwise, broadly speaking, we are away.
All right, Prateek Agrawal, really appreciate your time. So glad you could join us.
If you like this video, then like, share and subscribe to ET Now.